Hello guys, today I want us to talk about risk management. When you are trading, you must be able to control your risk so that you don't put your entire account on the line. Right? So the way you manage your risk, it can be, before you take the trade and calculate your risk, or it can be after you've taken the trade. How do you make sure that your risk is very well managed? Right? I'm sure you have heard of, someone has once told you, or you have read it online, where maybe they said you mustn't risk a certain percentage. Maybe someone will say, don't risk over 5% of your account. Whatever. Okay, this one, it looks nice on paper. When you say someone mustn't risk 2% of more than 2% of their account, it looks nice on paper. But when we go to the actual trading, this is not feasible. This is not something that you'd be able to do, especially when you're just starting to trade, because you are starting with a small amount. You are depositing a small amount. Most of you will be depositing small amounts. So when the account is small, how would I make sure that the risk stays this low? Well, if let's say you set up a $50 account, of which is not a good amount to trade with, but let's say you set up a $50 account. So it means for you, if we are saying, if we say never risk more than 5%, we are saying for every trade that you take, I think 5% would be maybe $2.5. So I mean, what is it that you're going to trade for you to not risk more than $2.5? Why one? So now I don't think a certain percentage it applies to everyone. This one, it works well when the account is big. Whatever. So now I think what you should do, when you're taking a trade, just make sure that you don't put all your amount at the risk. When you're taking a trade, make sure that trade, if it goes bad, it won't take your entire account when we're getting started. And then as soon as the account grows, then you can bring in the issue of certain percentages, to say that I'm not gonna risk more than 15% of my account, or 10, whatever amount that you decide on. Why one? And again, when you are taking trades, this is the one that most people, they always forget about, which is when you're taking a trade, make sure that your potential reward has to be at least 3 times your risk. I think I touched up on this one in one of the videos that I posted. So what we mean by that is that if you're taking a trade, and on that trade you decide to risk, let's say your account is still small, you decide to risk $20, make sure that on that trade, on that setup, I agree you will have done your own analysis. Let me give you an example. Let's say the price moved like this, and then now you are taking a buy here. Let's say it turned here even in the past. Let's say you do your analysis, your setup, and you find that this is a valid buy. I can take a buy from there. And then you go in and you decide to put your stop loss below that area. Let's say you put your stop loss there. And then the stop loss is what? Let's say it's $10. I'm giving an example. So you need to identify, based on the structure, based on the structure that you're seeing on your chart, where should you put your TP? Okay, so you must look at the structure and say, on this chart or this time frame, the next nearest resistance level or support level should be around somewhere there. So if the distance from here to there, it's not 3 times my risk, or 3 times the $10 that I'm risking. If the price was to move there, and I don't make $30, that in this case, because we're risking 10, then that trade is not worth it. I need to make sure that where I'm taking a trade, the potential profit to my nearest TP, or to my nearest area of resistance or support, it must be at least 3 times what I'm risking. Why one? So if it's not 3:1, then I shouldn't take it. We're trying to avoid a thing where someone would say, I'm taking a buy here, I'm taking a buy. You should never do something like this and then risk maybe let's say $50 to try and make $50. This is not trading. This is gambling. Because remember, when you're trading, things can go wrong. There's a day or a week where you're gonna have like you're gonna have like a horrible week or a horrible day. So you should make sure that when that happens, if it happens, you must still have something to trade. So if I'm trading 50-50 like this, then it means the day I have three losses in a row, then for me to recover, I have to have 3 wins in a row. Why one? And sometimes things don't go that way, and then it means you'll always be on the negative side. Mara, if let's say I'm sticking to the 3:1, right? I'm sticking to the 3:1. Let me show you. I want to show you something. So if I'm sticking to the 3:1, let's use the same example of 10 as our risk, right? It means for every trade that I take, I have a chance of making what? Of making 30, which is our reward. Ne? So if let's say I lose 2 trades in a row, it means how much have I lost? I lost 20, right? And then the third trade, I win it. How much did I win? I win 30. So it means even though I lost 2 trades, but I only won 1, I'm still on the positive side of what? $10. You see? That's why I'm saying it's very important to make sure that the risk that you are, expose your account to, it must always be at least, if it's more than 3, then that's even better. But we want to be, the space between where you're taking your trade to the next area of resistance or support, it must be at least 3 times what I'm risking, so that even if I was to lose 2 trades and win 1, at the end of the day, I'm on the positive side. But if I go with 50-50, it means if I lose 2, I have to win 2 for me to be at break even or to be back at 0. And sometimes things don't go our way. So that's another way of what? Making sure that you manage your risk. So make sure that when you take a trade, after doing your assessment or your analysis, if you find that you must make sure that the space between where you're entering and where you want to exit must be at least 3 times the space between where you're entering and where you put your stop loss. Then that's the rule of 3:1 that I think if you go with it, you will go far. Sometimes you can get, 10:1, which is even better. But we can't trade 1:1. Risking 10 to make 10, not worth it. Right? So that's the first way of trying and managing your risk. Make sure that you calculate it before you take a trade, and make sure that it is the profit or the reward is 3 times the risk. That's the first thing that you can do when you are trying to manage your risk using 3:1 reward compared to the risk. Right? So another thing that you should do, avoid adding more trades to losing trades. You'll find someone saying that if let's say they want to buy Nasdaq, for instance, let's say they take a buy here, then they say buy. Maybe they open 3 trades, and then the price dips in a bit. It doesn't go far, it comes somewhere, and then maybe when they jumped in here, they were just if I can put it like that. So they just saw the price was coming here, and then they're like, I'm going in. They didn't have any confirmation, then they just jumped in, and then the price went deeper by this much, and then it started giving you a confirmation that now it is about to reverse, and then you decided to add more. Remember, these ones are riding on a negative, these ones are losing, and then you should stop buying the trades that you took that are already losing, because just because you're getting the confirmation here does not mean the price would really go up. We don't have it, there's no guarantee. So to make sure that we don't lose more, already you are losing. So imagine if you add 3 more trades lower than that to the ones that are already losing, and then the price decides to continue doing that. What do you think is going to happen to your account? Why? So make sure that you don't add more trades to the ones that are losing. So the only time you can add more trades is if the ones that you have open, they are winning, and you manage to lock the profit. For instance, if let's say we do this and then I take a buy and then the price goes up, and then let's say when I took a buy my stop loss was there, yeah, and then when the price moves up and then I feel like it has moved up by enough for me to move my stop loss above, then I do this. I take my stop loss and put it there, and then it says maybe I logged in $15. So it means that if the price decides to come down, I will never take a loss. It will, the minimum that I can get is $15. Whatever. So if now let's say the price does this, and then I feel like I see confirmation, I do another analysis, I feel like it's gonna rise again from here, then I'm more than welcome to buy again. Simply because the first trade that I took, it is risk free, meaning it will never be a loss. Like we locked in profit, we move stop loss and put it there. So that's when I can add more. Mara, when the thing is dropping, and then I keep on adding, I can't do that, because imagine this is the one that I started with. It's a huge money negative. This is negative. This is negative. Why should I add another one? What if the price continues doing that? What's going to happen to the account? Why one? So you must make sure that you are in charge of your risk. Make sure you minimize it as much as you can. Whatever. So I think for now, those are the ones that are you should always keep in mind. You must be able to manage a risk before you even take trades, or before you even execute. How do I manage a risk before I execute? Calculate your risk. Stick to 3:1, minimum 3:1. So that's how you can make sure that you manage your risk beforehand or before you execute. Now I've executed. How can I manage risk? You can also manage risk after opening trades. So how can I manage risk? Don't add to losing trades, or only open more trades when the first ones that I opened are risk free, or I have managed to move my stop loss. Right? So, and another thing that I think I'm done, Mara, this is another one that I think I should just share. You will find someone saying, there are those ones that they will tell you they are trading double top. So they will say, as soon as the price gets here, they don't even know what's going to happen. Already they're saying the price is going to do this. Of which that is risky, but it can happen, but it's fine. That's not the main purpose of this video. And then let's say someone, this thing comes down, and then they call it what, neckline, and then as soon as they see this, they say, let me sell, and then they decide to put stop loss there, just because they feel like if they put it there, it's gonna be too wide. Why one? Of which, if you put it here, this is pointless. I mean, look left. Always, whenever you do something, look left. If I decide to put a stop loss here, when I look left, I can see that the price can touch. It has managed to come here. So what can stop the price from doing this before it drops? Why one? Mara, if I put the stop loss there, then it means even if it decides to play around first, I don't think it would reach there. If it reaches there, then it means it breaks the entire structure. If it reaches there, it means this thing of double top does not exist anymore. Why one? So another way to manage your risk, is rather reduce your size and open your stop loss. Why one? So the amount of risk will still be the same, but you'll have higher chances of winning because your stop loss is not going to be too tight. You'll give the price enough room to play around so that it can decide just in case it decides to play around before it takes off. When you'll be safe because your stop loss will be there. That one. So some people, what they will do is that when they are trading this, they will say sell, ne? And then they put the stop loss there, and then maybe they will say, let me sell 0.1, and then they risk what? Let's say they risk $50. Well, now instead of doing this, rather make sure that your stop loss is placed at the right place and reduce the size, reduce this. So rather execute with them at the same level, Mara, put your stop loss there where you'll be risking the same amount, which is 50, but let's drop this thing. You can drop it to 0.03. Why one? The size of your stop loss is 3 times their size, but in terms of the risk, it's the same. I just managed my risk by doing what? By reducing the stop loss. I mean the size. Why one? So those are the things that you need to take into consideration when you're trying to manage your trades and making sure that you don't put your entire account on the line. Why one? So calculate the risk beforehand, or stop adding towards adding trades on top of the ones that are losing. Only time you can add more trades is when you know that the ones that I opened first, they are risk free. And again, instead of setting up tight stop losses that are easy for the price to touch, rather stretch them and put them at the area which is like a proper level. If we doing this and we know we have failed to pass here, the stop loss, if I put it there, I know the price failed to get there, so it is most likely gonna fail to touch my stop loss. So rather trade like that and put the stop loss at the right area and reduce the size. There's no use in you using a bigger size matter setting up wrong stop loss, because the price can touch that and then you still get a loss. Now I put my stop loss up there, but I'm risking the same amount as you. Why one? So I think that's how you can manage your risk, guys. And then I'm gonna end it here. I will see you in the next one. Don't forget to like and subscribe there. See, we're growing nicely. All right, cheers, guys.